हाय, मैं हूं अपूर्व शेठ और मैं स्वागत करता हूं आपका द राइट चॉइसेस विद ओरेकल्स ऑफ दलाल स्ट्रीट के 68वें एपिसोड पे। अगर आप हमारा ये शो पहली बार देख रहे हो तो हमारी चैनल को ज़रूर सब्सक्राइब करें ताकि आप एक बेहतर इन्वेस्टर और ट्रेडर बन सको। एक साल से भी ज़्यादा समय से हम हर शनिवार सुबह 11 बजे एक इंसाइटफुल एपिसोड लेकर आते हैं और हम मार्केट एक्सपर्ट से एक्शनेबल स्ट्रैटेजीज लेकर आपके सामने प्रस्तुत करते हैं। दोस्तों, मार्केट आजकल बहुत ही वॉलेटाइल चल रहा है और ऐसी वॉलेटिलिटी में लॉन्ग या शॉर्ट दोनों ही साइड पर पैसे बनाना बहुत ही मुश्किल हो जाता है। तो क्यों ना हम एक ऐसी स्ट्रैटेजी सीखें जिससे आपको डायरेक्शनल कॉल लेने की ज़रूरत ही ना पड़े। जी हाँ, एक ऐसी स्ट्रैटेजी है जिसका नाम है पेयर ट्रेडिंग और आज के हमारे जो गेस्ट है वो पेयर ट्रेडिंग के एक्सपर्ट हैं। वो पिछले 10 साल से पेयर ट्रेड्स करते आ रहे हैं और काफ़ी सक्सेसफुल भी है। ये हैदराबाद से है और इन्होंने मैनेजमेंट इंफॉर्मेशन सिस्टम्स और कंप्यूटर एप्लीकेशंस में पोस्ट ग्रेजुएशन किया है। बाय प्रोफेशन ये एक सॉफ्टवेयर आर्किटेक्ट है और सॉफ्टवेयर इंडस्ट्री में 16 साल काम करने के बाद इन्होंने अपनी खुद की फर्म शुरू की है जो फाइनेंशियल मार्केट्स के लिए एप्लीकेशंस डेवलप करती है। इन्होंने पेयर ट्रेडिंग को आम इन्वेस्टर्स के लिए आसान बनाने के लिए एक सॉफ्टवेयर भी बनाया है और आज हम पेयर ट्रेडिंग के बारे में इनसे बहुत कुछ सीखने वाले हैं। सो आई एम वेरी मच एक्साइटेड टू लर्न फ्रॉम हिम। तो मार्केट्स के अलावा इन्हें बेकिंग और चेस खेलने का भी शौक है। तो चलिए स्वागत करते हैं महेंद्र पब्बा जी का। Mahender, welcome to the show. We are pleased to have you here.
Hi Apurva, thanks for the introduction.
Hi, thanks a lot for giving us your time and I'm sure कि आज का जो पूरा सेशन होगा वो काफ़ी इंसाइटफुल रहने वाला है। पेयर ट्रेडिंग इज़ अ वंडरफुल कॉन्सेप्ट। आई पर्सनली लाइक द strategies and pair trades that come up based on these strategies. So looking forward to learning from you.
Yeah, sure.
So before we jump into the slides that you have prepared for us, we wanted to know more about you. How did you begin your investing journey and how did you ended up getting so deep into the pair trades and the screener that you have developed, the software and the skill set that you have developed in pair trading. So please share us your journey in the markets with our viewers.
Okay. So I started my trading in 2011. So my office colleague joined as an agent in a broking company and he opened an account for us. So as I was from the commerce background, I know about the stocks, but I never traded. So initially started with 5K per month and did intraday trades. As usual, I lost. So then I looked for technical aspects and stumbled upon pair trading. As I was a software architect, I conducted lots of meetings, so I would not be in front of the system and watching the market. I wanted a trading system that will allow me to trade without monitoring continuously, and pair trading allowed me to do that. So I started with Excel and then wrote software to identify pairs based on the model. The first year I lost maybe 5 to 6 lakhs. The second year it was like a break even. And from third year onwards, I made profits. So at one point, continuously for 23 months, I made profit month on month. Then I thought the model is working and let others also benefit from the system. So release the software to others. Since 5 years, I've been conducting workshops on pair trading also.
Yeah, sure. So that's a great journey that you have been through. So what is your most important lesson that you have learned in your trading career so far?
The main thing was the patience. In trading, you need to have patience. If you don't have patience, you will not make money. That's the main thing. And pair trading also requires patience. Without patience, you will not be able to successful.
Pair trading is indeed a strategy which requires a lot of patience. So it will test you a lot of times. And sometimes it might take a slightly longer span for the strategy to work out. So it is really Good thing that you have spoken about patience at the beginning itself. So this is a strategy which is for patient investors. So now you have prepared a deck for us. So let's begin with the presentation and let's learn more about pair trading.
Yeah, so before going into pair trading, let's look at this graphic, large institute versus a retail trader. It's like a shark in the ocean and a small fish, but both of the fishes are surviving. So how is it possible? The small fish has its own security mechanisms. It will stick to its habitat. It will not venture into deep ocean, and it will be able to survive. Similarly, for a retailer, we need to have our own strategy to survive in this market. There are large foreign institutions that have billions and trillions of dollars at their disposal. Similarly, domestic institutions like LIC, mutual funds have crores of rupees for deployment. Now, can a retail trader with an average ticket size of 2 lakhs compete against these big boys who have unlimited funds at their disposal? And also, huge infrastructure is deployed by institutions for number crunching. They hire economists, market analysts, statisticians, programmers to develop new strategies. A retail trader with limited funds, limited infrastructure, limited research, and dependent on others does not stand a chance to succeed in this market. And also, there are algos, algorithmic trades. As of today, 95% of the total open orders are placed by algos. And 50% of the volume in a day is done by algos. And this figure is growing day by day. Now, can a retail trader compete with the speed of the algos? The simple answer is not possible. A commonly known fact is that more than 90% of the traders lose. So how to be in that elusive 10% of the traders who do make money in the stock market? So how can a retail trader succeed with all the drawbacks? He cannot compete in the shorter time frames or in the intraday, as algos are running there. As traders, we cannot hold the trades for a long period of time like an investor. So to succeed, we need a system that plays in the short to medium time frames. So there is a need for a trading system which is well-defined and easy to learn and implement, a system which requires minimum daily time, and a system which gives decent returns without risking the capital. A system which has less overnight risk, where large gap ups and gap downs should not affect the outcome of the trade. And also a system which does not require continuous monitoring. Of course, and it should be suitable for all risk profiles. When I say well-defined, it means the entries, exits, and stop losses are well-defined. So there is no confusion in that. So pair trading is one such strategy which satisfies all these conditions. Let's look at this graphic. Here, 1 year performance of all the banking index components are plotted. Overall, we see that all the stocks move in the same direction on a day-to-day basis. But if we observe the performance of two stocks separately, interesting facts come up. For example, if you look at these two stocks, SBI and Axis, both the stocks are moving in the same direction and also equal movement on a day-to-day basis. Both are like a jigri dost. Right? Similarly, if you look at these two stocks, HDFC Bank and Kotak Bank, both these stocks are also behaving in the similar fashion as the earlier stocks. Now, if you look at these two stocks, Axis Bank and HDFC Bank, one of the stock from the first set and the second from the second set, we can visually notice the difference in the chart pattern compared to the earlier ones. One stock is always outperforming the other one. For example, Canara Bank and BOB, similar pattern to SBI and Axis. Look at this chart. The performance of Dabur and HUL is shown for last 1 year. If we observe that at a certain point in time, one stock is outperforming the other one, and later the outperformance is reduced and both converge together. Now, as a trader, when we look at these charts, we know that the performance difference between two stocks will vary on a day-to-day basis. And sometimes the difference in the performance increase and decrease more than normal over a period of time. As a trader, we take advantage of the performance difference by initiating a trade, going short on the outperforming stock and going long on the underperforming stock. And when the performance difference comes back to the normal, we exit the trade and make a profit. Here, that strategy monitors the performance of two historically correlated securities. And when the correlation between the two securities temporarily weakens, the paid trade would be to short the outperforming stock and to go long on the underperforming one. And betting that the spread or the gap between the two would eventually converge. If you look at the earlier graphic, you see here, there is a performance difference here. The Dabur is outperforming and HUL is underperforming. But after some period of time, the underperformance is closed and both are at a similar level. Similarly, if you see here, again, the gap is increased here and it is closed. Similarly, gap is increased and closed. So, as a trader, we take advantage of this price difference and short the outperforming stock and go long on the underperforming one.
This is normally very counterintuitive. Normally what people would do is that they would go long on the stock which is outperforming and go short on the stock which is underperforming. But here we are doing exact opposite.
So actually we are going against the market. We are shorting the outperformer and going long on the underperformer. But we will do that when the gap between them has hit the peak. So when the gap starts decreasing, at that time only we will enter. So in a nutshell, pair trading is a market neutral trading strategy that seeks profit from the difference in the price change between two related instruments. When I say market neutral trading strategy, it means a strategy that does not depend on the market movement. The market can be uptrend, downtrend, or sideways. For pair trading, it does not matter because we are seeking profit from the difference in the prices of two related instruments. We are not worried about individual prices, but we are looking at the gap between them and whether the gap is closing or not. So, what causes the divergence within a pair? We see here. So, the divergence within a pair can be caused by temporary supply demand changes. Somebody comes on TV and says that the stock is doing good. So people generally tend to follow them and the supply or demand is disturbed there, or the supply and demand is increased there. So there would be sudden demand for one of the stock, and there would be large buy and sell orders for one security, maybe a FII or the mutual funds put a large order for one of the securities. So obviously that will affect the price of that stock. And reaction to significant news about one of the companies. So due to these reasons, the gap between the two will temporarily increase and later the gap will be closed when the news is digested. Now let's look at the example to understand pair trading. Here, ICICI and Axis Bank are two different banks doing similar kind of business. Depending upon the market conditions, the two banks have shared similar dips and highs. So an example, if you take Axis Bank at 100 rupees and ICICI at 100 rupees, now due to certain market conditions, ICICI has gone to 120. Now there is a divergence of 20 rupees. Now, as a pair trader, when we see this divergence, we take advantage of that and we go long on Axis Bank at 100 rupees and sell ICICI Bank at 120 rupees. Now the convergence can happen in many ways. For example, in bull market, ICICI Bank has gone from 120 to 140. At the same time, Axis Bank would have moved from 100 to 140. So the gap is closed here. Similarly, in a bear market, Axis Bank would have fallen to 80, but at the same time, ICICI Bank would have fallen from 120 to 80. Still the gap is closed. And in range bound market, Axis Bank could move little up, ICICI could come down, or ICICI Bank could stay there and Axis Bank could move to that level, or vice versa. So in all the cases, we are looking at the gap and the gap is closing or not. So we are not worried about the individual prices. Now, if you look at what instruments you can use for pair trading in spot market, you can do with stocks and commodities. Of course, in Indian market, you cannot short the stocks without holding. But if you are holding enough stocks, you can do that also. And commodities, of course, you can do with commodities. And futures we can do. And also options can be used to pair trading.
So Mahender, this is quite interesting. I have seen people doing pair trades mostly in futures and to an extent maybe in spot market as well. But options is quite different. So can you throw some light on that as well?
Okay. So see, the strategy remains same, but which instrument you are using will depend upon your priorities. If you want to do with options, you need to be a little experienced person. Otherwise, you will not be able to do with options. So futures would be a straightforward thing, but options has so many dynamics are involved. So an experienced trader only will be able to use options for pair trading. So if you look at the benefits of pair trading, one is the controlled risk. In pair trading, an automatic hedge is created where one leg of the trade acts as a hedge against the other. So risk is somewhat controlled. And profit regardless of market direction. As it is a market neutral trading strategy, the market direction has the least effect on the outcome. So there is no direction risk. In pair trading, a second instrument acts as a hedge against the first, thereby removing the directional risk. And of course, there would be smaller drawdowns compared to a single side trade because of the automatic hedge.
So this is one major advantage. A lot of times traders are up in the middle of the night whenever and they are checking SGX nifty kya chal raha hai and what is happening over there. So whenever these traders have big positions, they are quite worried about it. So in pair trading, you remove that directional risk and जो overnight भी gap ups या gap downs होता है, तो all those things are removed. So to an extent, that way pair trading is a very good strategy.
Yes, that's the main advantage of pair trading, where you are not worried about whether tomorrow market is going to open gap up or gap down. Right. So tension-free trading. So you can sleep without any tension because the hedge against each other will protect your trade. So coming to the disadvantages or risks in pair trading. See, although strategy does not have much downside risk, there is a scarcity of opportunities, and for profiting, the trader must be one of the first to capitalize on the opportunities. And also, each trade requires twice the margin, brokerage, and taxes. For a single side trade, you just take a long side or short side, and that's it, right? In pair trading, you are doing twice. So for a trade, you are doing 4 trades rather than 2 trades. So the margin requirement would be double, brokerage and taxes also would be double compared to the single side trade. And stocks specific risk would be there. So while pair traders enjoy significantly reduced market risk and also sector risk, the individual stock risk remains there, right? As an example, a company would receive a takeover offer. So that news is for a particular company. So those things are there, so which will affect our trade. And another risk is pair drift. While pair trades are implemented on basis of extensive historical analysis, but there is no guarantee that the stock will converge. In our example, Axis Bank and ICICI Bank, we said that Axis Bank is at 100 and ICICI was at 120, and they both converge. But what if ICICI has moved from 120 to 140 and Axis Bank has fallen from 100 to 80? So the gap which was there 20, now it has gone to 60. So that thing will also happen. So that is called as a pair drift. So we need to be careful and we need to identify the pair drift as soon as possible, and we need to get out of the trade. And we have lots of parameters where we look and we identify pair drift and we get out of the trade. Yeah, if we see this chart, here if you see there is a gap which is created and gap is closed. So again the gap is created and gap is closed. So here we would have thought, okay, again the gap is created and we would take the trade here. But the gap which was created never converged, and slowly the gap started increasing. And over a period of time, the gap was so much that you would have lost a lot of capital also. So this is the pair drift. Now, but for example, this Maruti and Nifty, after that particular day, it never went up and it came down. See, 9,791 was around the 10,000 peak. Then again, it fell. But at the same time, Nifty from 10,000 is now at 17,000, but Maruti is at the same level. So individual pair will take different time. Some will converge within a month, some will converge in a day also, some will take longer than 2 months.
So there's this old market saying that markets can stay irrational longer than you can stay solvent. So I think this is particularly true in case of pair trading as well. That sometimes if the pairs drift, then it might take very long time for them to reduce the spread that was there. So you have to be careful about those things.
Yes, so there are certain statistical tools which we use to identify the drift and we will get out of the trade. Coming to the calculations, statistical calculations which are involved in pair trading, the first is the price ratio. See, for a single stock, it is easy to track whether it is going up or down. By seeing its price chart, we will know that it is going up or down. But how do you track two stocks? So to track a pair, we require a single value. So we use the ratio between the two stocks, that is the price ratio. So to get the price ratio, we just divide the higher value stock divided by the lower value stock. Next is the mean price ratio. It is the average price ratio of a given period of time. Here we take like 1 year data, some takes 90 days, some take 120 days. But in this model, I take last 1 year data and calculate the mean price ratio. Similarly, we need to calculate the standard deviation, how far it generally goes from the mean. And we need to calculate z-score or the z-score, which tells us how far it is from the mean. Right now, how far it is from the mean. So these things will help us in deciding whether the gap is at the peak or is there a scope for it to further increase. And other calculations we use is correlation, cash neutrality, and some fair value. Now, so quickly, I will show how to calculate some of these calculations. Coming to the calculations, in the first column, price of first stock is taken, and in the column B, the price of the second stock is taken. And to calculate price ratio, I will say higher value stock divided by lower value stock. So we get price ratio is 1.687. Similarly, I will calculate for each day. So the first day it was 1.68. Now it has gone up. It is 1.70 because one of the stock has outperformed compared to the other one. Again, next day it came to 1.69. So similarly, I will calculate for last 1 year data. So here I have taken like 248 days. So on last day, it was like 1.86. To calculate mean, I'll simply say average of these values. So the average price ratio is 1.73. Right now it is at 1.86. Now if we calculate minimum, it was at 1.59 and maximum at 1.86. Now
So minimum and maximum values are for the last 1 year.
Yeah, last 1 year. We can create a price ratio chart. Let me select this data. Say 30. Yeah. This is the price ratio chart. Initially, the first day it was like 1.68, then next day it went up, then came down. And again, one of the stock was outperforming or underperforming, it fell. Again, it went up. Now, if you look at the mean, it is at 1.73. So it is somewhere here, 1.73. So the average of the price ratio is somewhere at 1.73. Then next is correlation. I can use correlation function to select array 1 and array 2. Array 1 would be the prices of first stock. Then the second stock. So the correlation has come to 0.96. Now, if I want to calculate in percentage terms, it is 96.39%. So that means they are highly correlated, because when you calculate correlation, the values would be from -1 to +1. So if it is nearer to +1, that means they are highly correlated. And this one is like highly correlated because it's 96.39. Similarly, I will calculate on a general terms how far it will go from the mean. So I'll say standard deviation of the prices. So the standard deviation has come to 0.064. Now, using the standard deviation, the mean and the actual price ratio or the current price ratio, I can easily calculate from mean how far it is. I just say current price minus mean price divided by the standard deviation. Standard deviation is 257. Okay, so it is current price minus the mean price divided by the standard deviation. So we'll get at 1.96. Right. So this is 1.96 times of standard deviation. If we go back to the slide, here the price ratio chart is plotted. See, these are the price ratios on a day-to-day basis. The price ratio changes, it goes up, goes down, and a mean price ratio is plotted here. Now, if you see, the price ratio is quoting below the mean. Sometimes it goes above the mean, again came below, again it quoted above the mean. So it has gone little far away from the mean, and again it returns back towards the mean. Similarly, it went down, again came back. This pattern happens always. So it goes far away from the mean, again it come back towards the mean. So that's why pair trading is called as mean reversion strategy. So whenever it goes far away from the mean, we initiate the trade, and whenever it comes back towards the mean, we book the profit. Similarly, here it went below the mean, and we take the entry here and book the profit when the when it comes back towards the mean. So this is the basic idea behind the pair trading. So basically what we are doing is we are calculating the price ratio, and the price ratio, when it goes far away from the mean, we take the trade, and whenever it returns, we book the profit.
So how does Z-score help in this?
Okay, so as we have calculated that the standard deviation is 0.06. So let me, okay, for example, this is the mean. Here it is the mean. So when you calculated standard deviation, this is the value. Now we said that when you calculated this score, it came to 1.96. So this is the 1.96 level. And there would be another 3 standard deviation level here. Similarly, at the bottom, this is the 1 standard deviation level, 2 standard deviation level, and 3 standard deviation. So it is the 3 times of the standard deviation. So here, when we see that it has, in normal terms, it will range in this range. But sometimes it will go beyond that range also. So it goes to 2 times of the standard deviation, and it also goes to 3 times of the standard deviation. So the price ratio will move in +3 to -3 range.
Okay. So Z-score is the difference, or Z-score is the how far your price ratio is from the standard deviation or from the mean.
From the mean, yeah. So that will tell us how far the price ratio is quoting from the mean in terms of standard deviation, in terms of number of times of standard deviation. So generally, when you calculate the Z-score, it will be in the range from -3 to +3. So that would be the peak. So if the data is normal, then it will be staying in that range. So we take help of the Z-score calculation, and we'll say that, okay, if it reaches this level, that means the gap between the two has come to a peak, and we can look forward to enter the trade.
So basically it shows the extreme points at each side, on each side. So if it is hitting, the Z-score is hitting +3 or closer to +3, then it's an extreme on the top. And if it's hitting -3, then again it's an extreme.
Yeah. So that way we take the trade and book profit.
So Mahender, it's absolutely great that you have explained the whole process of identifying a pair trade, or we have just begun. But one thing which I can see from here is that it could be too overwhelming to do all these calculations for someone who's working professional or who doesn't have time. So is there an easier way out for a person like him?
Yeah, as you said, initially it looks overwhelming. But if you understand the concept, if you understand the calculations, it would become much easier. So the calculations can be done in Excel, but to do multiple pairs, it would be a difficult job. So to overcome that, I have developed a software which is called as a pair trade screener, and it will do all the calculations and it will give you the signals. So you just need to follow that and you can easily trade. So I'll be showing the screener in the next session.
Sure. I'm sure our viewers will love to use or love to see the screener and how it can make their lives easier.
Yeah, definitely. I'll show you that.
तो ये थे महेंद्र पब्बा जी. इनके साथ हुए इस एपिसोड में हमने पेयर ट्रेडिंग के कुछ बेसिक सीखे और समझे. आने वाले एपिसोड में हम पेयर ट्रेडिंग के बारे में और भी ज़्यादा विस्तार से जानेंगे और इनका बनाया हुआ सॉफ्टवेयर भी देखेंगे जिससे पेयर ट्रेड्स ढूंढना काफ़ी आसान हो जाए. तो चलिए मिलते हैं अगले एपिसोड में. तब तक के लिए हमारी चैनल को ज़रूर सब्सक्राइब कीजिए और इसे दूसरे लोगों के साथ भी शेयर कीजिए. थैंक यू.
When we want to enter, we look at 3 different entry points. One is at the 3 standard deviation, the second is at 2.7, and third is at 2 standard deviation. So for this pair, if you look at 3 standard deviation, you got 4 opportunities and you would have made like 1.5 lakhs in those 4 opportunities. So I can expand and see what were the 4 opportunities. So